Callie, the mood music, it's pretty grim. Should it be?
Oh man. Okay. Well, I'm not afraid, but I'm generally an optimist, so I'll give myself that. But yeah, you're right, Katie. The Fed's going into this. It's likely that they're going to hike 50 basis points, which would be the biggest hike since the early 2000s. But the markets are kind of there. The whole theme of markets lately has been all about the Fed being a little behind the curve, but markets being way ahead of the curve. So the hike may not matter as much as Powell's rhetoric here. Powell is going to try and bridge the gap between what markets are thinking and what the Fed is thinking. And that's what we'll be watching closely.
Yeah, that's the thing, Callie. I mean, markets, if the Fed has been behind and markets have been ahead, then I'm wondering what moves markets today, because surprises move markets. And I'm wondering what we could hear from Fed Chair Powell that could cause investors to really change the way they're thinking about what the Fed's going to do when it comes to rate hikes or when it comes to balance sheet reduction.
Honestly, there isn't much that would surprise the market right now. It really is pricing in going to worst case scenario. The market's trying to out-hawk the Fed, and so far as it's succeeding. You did mention the balance sheet, Tim, though, which could be an interesting little wrinkle to watch, because the Fed is expected to bring details of the balance sheet runoff to this meeting, and it's double barrel tightening. We all focus on the interest rate hikes, but balance sheet runoff is tightening as well, especially with 10-year yields near 3%. And a lot of those bonds on the balance sheet being that longer term vintage.
That longer term vintage. Well, Callie, it was soothing to hear you say that you're not scared. But as you said, if you look at markets, definitely some worst case scenario pricing going in there. You look at the S&P 500 down over 12% year to date. The NASDAQ 100, your big tech stocks, down over 20% year to date. I mean, with this sort of backdrop that you described, and perhaps maybe things won't be as bad as maybe the markets are pricing in right now, is this a buying opportunity?
Well, I'm a long-term investor, so that's another reason why I'm not scared. I look at these 10% sell-offs, even if the sell-off accelerates a little bit more, I don't need my money for the next 5 to 10 years, so I can think on that longer-term horizon. But I will caution people against, stepping back and saying, okay, sure, I think I'll be fine here, because this doesn't necessarily mean we're out of the woods yet. We think the market is in a place where it's absorbed a lot of bad news, but that also doesn't mean that markets could rally back to record highs quickly. Growth stocks here might struggle too. In a period of slowing growth and rising rates, it's really hard to look at growth and see short-term opportunity. And a lot of our customers are in growth stocks. So while we're optimistic, we tend to hammer that point home as well.
Callie, I just got back from the Milken Institute Global Conference in Beverly Hills, and certainly a lot of it's focused on the private markets, but we did speak to a lot of people in public equities, one of those being Chris Ailman, who is the Chief Investment Officer of the California State Teachers Retirement System, CalSTRS, which is, of course, massive. What he needs to shoot for is 7% on average in order to satisfy pension obligations for teachers in the state of California. He told us yesterday on Bloomberg Radio that we all need to moderate our expectations of returns over the next decade. That what we saw over the last decade is not necessarily going to happen over the next decade. What's your reaction to that?
It's certainly possible. I don't have a crystal ball. And it does make sense when you think about it. If we expect inflation to stay high, we could see a different mix of returns here. I try not to lean too much into the forecasting. I understand why a pension manager would do that. And more on the institutional side would try to do that. I just encourage retail investors to watch their goals. And one thing I'll add there too is, a lot of people don't need big returns per year to reach their goals, especially if they're longer term goals. They just need to stay in the game. So right now, that might be the name of the game. Stay in the game and watch what your goals are, and try to stick to the strategy that'll help you reach those goals.
And Callie, in this conversation on our show call this morning, we had a spirited discussion about, what the future could bring. Because if you look over the past 2 years, really, you could throw a dart at markets and you were going to make money almost wherever it landed, unless you really threw it pretty much off the map. But to your point that a lot of your clients, they're in growth stocks, those could struggle. Where would you hide out right now? If growth stocks are going to struggle, which I often think of tech, communication services, for example, what are the sectors that could do well here in this environment?
Well, your classic hideout here is defensives, right? And defensives are looking a bit expensive, but hey, if you want a safer place to turn in the stock market, defensives are it, and you don't necessarily get into them for the return. So we've been talking to clients all about that and about hedging their portfolios. We also really like cheap cyclical sectors right here, but we're also telling our clients to explore, barbell strategies that help them diversify. Because to be honest, it's a very uncertain environment. We can't tell the future. So in environments like these, it may make sense to be exposed across the risk spectrum.
And Callie, I know earlier in April, we just missed each other in Miami. You were at the crypto conference. I was at the ETF conference a week later. But I'm curious to know from the conversations
you guys both got the same strain of COVID, though. So in a sense, you kind of hung out.
We did.
Yeah. It was a bonding moment for us both. Both got COVID in Miami in April. But in any case, you were at that crypto conference. And I'm curious, in the conversations you had, how much was this macroeconomic environment? How much were Fed hikes and the fear around that present in your conversations?
Yeah, that's a great question. So there wasn't a lot of nervousness there, but it kind of makes sense. A lot of people that I encountered at the Bitcoin 2022 festival were focused on the long-term aspects of crypto and the innovation that the technology can bring. Excuse me, I'm getting over COVID, so stumbling over my words. But, the fact that they're looking long-term makes a little bit more sense, that they wouldn't be worried as much about the Fed hikes in the short-term outlook. But there was some nervousness there for sure. There was a lot of optimism, but an undercurrent of nervousness. And I think that's prudent too. I mean, Bitcoin and other cryptos are acting a lot like the stock market. And if, risk assets are affected by rising rates, we could see Bitcoin, stick around these levels for a bit.